We're about to enter an economic unwinding, with the market aggressively pricing in multiple rate cuts this year. But it's unlikely to take us back to that cheap money era where interest rates were close to zero.
Yeah, that period was the outlier, and people need to keep that in mind. So when they're thinking about where we can get back to, the world's changed significantly, thank goodness. We don't want to get back to zero. Zero was not a good place to be. Central bankers certainly didn't want to be there, because then you end up with all the unconventional policy solutions that, of course, we're now trying to unwind all the issues that we have with that.
The US Federal Reserve kept rates steady last week, but is expected to start moving them lower later this year, in line with the downward trend in central banks' measure of inflation, including here. Annual growth in our consumer price index is at 3.3%, less than half the 7.3% peak from 2022. But our economy is ugly. Unemployment is ticking up, while consumer spending and house values are in decline. The services and manufacturing industries are contracting quickly, with the period of pain they've experienced now longer than the GFC. That's clearly put us on course for rate cuts, and the wholesale interest rate market is massively pricing it in, with the OCR expected to fall from the current 5.5% to 3.75% within a year. The two-year swap rate recently hit a two-year low, leading some major banks to lower their retail rates. That means the market is doing some of the Reserve Bank's unwinding work for it, bringing relief to borrowers. But it also may demand it move soon. Whenever it does, that would mark the end of one of the most rapid and restrictive rate hiking cycles our economy has ever seen. Seán Keane watches the rates market closer than anyone I know. He expects the Reserve Bank will have to respond to our economy soon. Seán, good to see you. Thanks so much for having us in. Good to be back.
Thank you, Madison. It's great to be here.
It seems like it's consensus now that cuts are coming this year. Is that correct?
Yeah, absolutely. The market's pricing them pretty aggressively.
What is your forecast? I'm assuming you're picking November, and if so, to what degree?
Yeah, I think they'll cut it by November at the latest. All year I've thought probably 50 basis points in November, because there's a very long gap between the November monetary policy statement and February when they come back. So I thought 50 at the end of the year would be right, and then they come back again in February, probably another 50. The market's a little bit earlier now, so the market's 50-50 in terms of probabilities for an August rate cut, which is pretty early. And then it's fully priced by October and again in November. So we've got about 73 basis points of easing by the end of this year.
Yeah, you've been pretty early on this, on looking at the data and assuming that cuts are going to have to come this year. What did you see that other economists didn't?
I think one of the benefits of my role is that I look overseas as well as looking domestically. And it was apparent to me that not only was the overseas markets, overseas economy starting to slow, but that the general picture of interest rates was probably peaking. These things move in cycles. So as we started to turn overseas, I thought it was probably going to happen here. And the analysis of the data here domestically was pretty weak. What kept the RBNZ where they were was inflation. And the inflation number is their mandate. That's what they focus on. But the underlying activity levels in the economy were really weak.
August isn't completely out of the picture.
No.
How likely is that, do you think?
Well, the market's 50-50. So I think it's too early. I think it's very hard for any central bank to go from talking about hiking rates at the last monetary policy statement in May, which is what they did, to suddenly cutting in August without some sort of big global event. So I think what you're going to see is a change in tone, a sharp change in tone and forecast, but I think they'll leave the OCR where it is.
You mentioned inflation, and we know that CPI is paramount. The headline figure is going in the direction that the RBNZ wants and expected it to. That's good news, effectively. But can we trust it?
Yeah, all the data is subject to revision, as you know, Madison, better than me. At different times in different cycles, inflation's affected by different things. So we've got a number of different metrics for our inflation. So we have headline inflation. We have core that the RBNZ look at, and then we've got the two sub-components of tradable and non-tradable. Now the inflation rate is falling, so we're at 3.3%, which is great. The RBNZ's target rate is to get it back to 2%, the midpoint of their target band of 1 to 3. So they're a little bit higher. The projections suggest that we're going to be back inside the 1 to 3% band by the end of this year, which is great. But the RBNZ's focus has been on getting back to 2, and 2 is a long way from 3.3. Now, to get to 2, we've got to have both tradable inflation and non-tradable inflation falling. Tradable inflation is driven by global factors, largely outside of our control. So things like international prices that feed through to New Zealand. That's down at 0.3%. It's already about as low as it can go. Non-tradable, which is domestic factors, that's at 5.4. And the RBNZ's reluctance to ease or to give softer guidance has been because of the stickiness of non-tradable inflation. So they need that to come down.
So it's not just a matter of getting within that target range, it's a matter of staying there too.
Absolutely. So, Adrian's been very clear, and the MPC have been very clear that it's not just about getting to 2 and then bouncing off it, it's about getting to 2 and staying there. So that again is part of that hawkish message that they gave last May.
But that headline inflation figure with a 3 in front of it, everyone's kind of screaming from the rooftops that that's awesome news.
Yep.
Not the Reserve Bank quite yet, but that official cash rate has a 5 in front of it. So that spread, that discrepancy, kind of demands that they have to cut anyway, does it not?
Yeah, I think one of the reasons I believe that that monetary policy is achieving traction is that the spread is so wide between not only current inflation but the projected inflation rate. So if you look at the RBNZ's last set of projections in May, by Q3 of next year, they've got the OCR unchanged at 5.5, but inflation is down at 2.2. So you've got this enormous 300 odd basis point spread between the two. Normally you would expect it to be around 160 basis points, so around about half of what it is, and I think it's going to get back there. So my expectation is that the RBNZ will lower their projections for the OCR, so that they sit around about 150 to 160 basis points above where they think inflation is. And if you think inflation is going to be 2 by the middle of next year, well, that puts the cash rate somewhere around 3.5, 200 points below where we are today.
And another spread that you have been quite vocal on calling out is coming to those OCR projections and what the Reserve Bank has stated on paper versus what the market has actually priced in. Very big C gap there.
Yeah.
Explain that to me. How did the market price something so differently to what the RB itself did?
Yeah, I think one of the challenges that the RBNZ has had is that the May monetary policy statement was surprisingly hawkish for an economy that was in recession. 4 of the last 7 quarters have been negative growth. 6 of the last 6 quarters we've had negative per capita growth. And the market's looking at this and saying, this economy is slowing very fast. It started to build in easings. And then the RBNZ came out with a monetary policy statement that talked about hiking interest rates, and it slightly raised its OCR path. Now, there were various reasons for that, including a reassessment of the amount of spare capacity that we have in the economy. But I think those concerns are gone now. Even though that was only in May, it's pretty clear now that we're slowing really fast. So the most recent BNZ, PMIs and PSIs, the PSI, the Performance of Service Index, that just printed at 40. Which is the lowest it's ever been outside of the COVID period. So domestic activity is extraordinarily weak. So the market's been looking at the activity levels, and it's been assuming that the RBNZ will get the inflation traction that it expects.
Is it unfair or fair to say then, based off that assessment, that the Reserve Bank has kind of been blinded or blind to the ugliness of the economy that people in the market like yourself have clearly seen for a while?
No, I wouldn't be that harsh on them. I think they've got one mandate specifically, which is inflation. They're adjacent to that, they've got to achieve their objective without causing undue volatility in a bunch of other variables, including output, interest rates, and the exchange rate. So they can't be blind to what's going on elsewhere in the economy, and that includes unemployment. Unemployment's at 4.3. The RBNZ think it will be 5 by the end of the year. I suspect it might move a little bit higher than that, and we might actually push, quite quickly in next year up towards 5.5. Now, historically, our 25-year average is 5.2. So right now, unemployment's still pretty low. So if you like, there's room for unemployment to go up without it being an outlier. But the bank's focus has to be on inflation because that's what their mandate requires. The question is being in the band sufficient, or do they need to be at 2%? For a long time, they talked about 2%. the market thinks being in the band is satisfactory.
I did want to ask you about how all of that other data, economic data, intersects into central bank thinking as well. You've already mentioned labour market statistics and what's happening with employment. How much weight do they place on all of these other things, including asset prices as well?
Yeah, I mean, everything obviously folds in ultimately to what the RBNZ are looking at, and it's concentrated in one number, which is the inflation number. So it all has an impact. And it's a necessary part of what the Reserve Bank does, that they monitor all asset price changes across the economy. Now, some of them are more immediate in their impact, some of them are more long-term. The big one in New Zealand is obviously house prices. House prices are the key asset for most households. And Adrian, to his credit, when he took over as RBNZ governor, talked about the fact that as a country, we can't get rich selling houses to one another.
We're trying though, aren't we?
We tried for a long time, and when we had foreign people coming in and buying houses of us, sometimes you do get an appreciation in terms of your valuation because you sold it to a new entrant. But generally, in a closed circuit economy or a closed economy, if I sell to you and you sell to somebody else, there's been no appreciable change in value. They've been very clear that getting house price appreciation under control was one of the objectives of tighter policy. And they've done that. And again, Adrian, to his credit, was probably the most honest central banker in the world in saying, we need a recession. I mean, my goodness, Jay Powell couldn't say that in the United States, and there's no way that Michelle Bluck could say that in Australia. But Adrian said it here, and most people agreed inflation was too high. Now, part of getting inflation under control is getting house price growth under control. And they've achieved that with a very rapid appreciation in the OCR, which has fed through to mortgage rates. Because in New Zealand we had a very high percentage of fixed rate mortgages, it took monetary policy the best part of 2.5 years to really get traction. And so at the first half of this year, the RBNZ were pretty clear that they were waiting for that large mortgage refinancing roll to take place and that they wanted to keep rates where they were. That's largely happened now, which is a good thing. From here, I think as interest rates start to come off, people talk about, is it time to get back into housing again? Is it going to take off? I don't think it will in the same way that it has in the past. And there's a few different things that have changed. Principally, the RBNZ's macro-prudential tools have changed. So they've had LVRs for a while now, so loan-to-value ratios. That's an efficient and effective tool. But with an LVR, as house prices appreciate, your ability to borrow increases as well. You can leverage against the asset. The new tool they have is debt-to-income ratios. Mm-hmm. And debt-to-income ratios have a degree of power that's multiples of the LVR. So your house price can go wherever you like, but unless your income increases, you cannot borrow more. And they've got the approval to use that. They haven't used it yet, but that will give them a lot of confidence that if the market starts to move, they can rein it in. The other one is our external position has changed in that we're not as welcoming of foreign money. So unless you're a New Zealander, an Australian or a Singaporean, you can't buy most property in New Zealand. And you compare that with Australia, where their house prices are obviously appreciating significantly versus us. That's the impact of foreign buyers. Now, different people have got different views about whether that's a good or bad thing, but the reality is they can't come in right now, so our house prices are pretty flat.
That's the rules. This all speaks to how restrictive the economy and the reins on it are going to remain, even if and when interest rates reduce, right? What kind of a floor do you think the Reserve Bank will allow this cycle to end at, noting that we're certainly kind of not in a reflective phase yet because we're still kind of in it at the moment, but I think it's fair to say that it's not going to be back to that zero interest rate, asset price inflation era that we once had, right?
No, I don't think so. That period was the outlier, and people need to keep that in mind. So when they're thinking about where we can get back to, the world's changed significantly, thank goodness. We don't want to get back to zero. Zero was not a good place to be. Central bankers certainly didn't want to be there, because then you end up with all the unconventional policy solutions that, of course, we're now trying to unwind, all the issues that we have with that. So the RBNZ's latest assessment of the long-term neutral interest rate is 2.75%, 2.75. Shorter term, I think it's probably 3 to 3.25. So in this cycle, we probably get down to about 3 to 3.25. But there's some risk that it could end up higher than that, because as the world changes, and it is changing, and we don't know what's going to happen with future trade agreements and the US view of how it wants to trade with the world, the efficiencies that we get from trading internationally they diminish as borders close. So a big part of the deflation that we've all enjoyed over the past 40 years has been the opening up of global markets, the ability to arbitrage away costs. If it's cheaper to produce something in Malaysia than in Melbourne, you do it in Malaysia. If it's cheaper to make something in Europe rather than in New Zealand, you do it in Europe. You can do that when markets are open and you've got free movement of goods, services and labour. As borders close, as trade restrictions are put in place, you don't have that same ability and domestic prices rise. And onshoring, which is what the Americans are doing and the Australians are doing now as well with some things, that will raise domestic prices.
Interesting. So this unwinding, this easing, it's not like any other time before because the world is different geopolitically.
Yeah, there's some different dynamics. What we've had over the past 40 years was different from anything we saw before. We brought the world's second biggest economy into the global market. It wasn't the second biggest economy at the time, but it is now, China. We brought it into the global market and it created massive deflation globally. Well, as borders start to close, trade borders start to close, that goes into reverse to some extent. Not to the whole extent, but to some extent.
Looking at our system, it survived relatively well. We jacked up rates at a pace kind of unseen before really, and also kept them at a height for a length of time that surprised pretty much everybody in the market, most economists and banks certainly. What do you think we've learned about monetary policy and the way in which it can be used?
That's a great question. I think the learning is, one, be active when you need to be active. So the Reserve Bank acted in New Zealand quicker than most central banks around the world. In my view, they were still too slow. I would have liked them to have been more active more quickly. On the way down, now they're going to have the same challenge. So the market is obviously running well ahead of them because what the market sees is that the economy is hitting a wall. Unemployment's going to go up very quickly. Inflation's going to come down very quickly. The longer the RBNZ takes to unwind the hikes, to get back down to about 3.5, the longer it takes, probably the lower they'll have to go. So the cycle will be extended. So faster movement is probably better because the transmission mechanism seems to be much quicker than it used to be. Central banks still talk about monetary policy taking 15 months or so to have an impact. My strong impression of it now is it's probably closer to 6 to 9 months because market pricing does the work for you.
A lot to watch, worry and wait about, Seán.
As always, Madison.
Thank you so much for your time. I appreciate it.
All right, thank you.
Thanks for watching Markets with Madison. If you enjoyed this interview, please hit the like and subscribe buttons below. I do all of the research for these episodes myself, so your support means a lot. I always love to hear your feedback and ideas, so please drop any thoughts in the comments below. Now go put your money to work.